Going on, guys? Coming at you with a new video. I know I haven't uploaded in a while, but I haven't really had much interesting topics to talk about. But there has been a certain topic that's been on my mind for the past 3 to 6 months, and that's been asset prices versus the real economy, or the stock market versus the real economy. And what we've seen over the past year is the S&P 500 has been soaring, from a low of, approximately 2,300 all the way up to a record high of, 3,205. Um, but, through that, there has been a lot of uncertainty with the US trying to trade deal. There's been Brexit, and global growth has shrunk. The global economy hasn't been growing as fast as it has been in the past. Same with China's economy and the US economy, which are the two biggest economies in the world. But it just seems that the stock market has been roaring and real estate prices have been roaring. And so wanted to create a discussion about that, why that may be, and why over the past 10 years, when there has been little dips like they just kept on going up and up and up, um, as we can see here. And there's a few theories I have, or a few ideas why the fundamentals seem so out of whack, where the economy's going bad, earnings are going not great, and PE ratios are getting crazy. And first thing I think that's supporting this is, compared to 20, 30 years ago, is a lot of a fire movement would obviously be contributing to that. People just investing in index funds every month, 3 months, 6 months, not caring about the prices, because as we've been taught, that no one can predict the market. And even if it's at an all-time high, now, like it was in 2007, it's still more than doubled since the 2007 all-time high. So we may think this is a crazy, but in 10 years it might be double this. Um, so that's, I think, maybe a factor, is the fire movement becoming so popular, um, and people just investing no matter what the price is, and just investing for the long term. Um, and another thing I think maybe contributing that is, now a lot of countries have mandatory retirement investment accounts. With 401k, Roth IRA in the US, and in Australia we have superannuation, where out of every pay slip they take a percentage out and invest it for you. So no matter what the stock market is doing, if it's crashing or it's at all-time highs, those retirement accounts are still investing, putting money in. And also, to people are a lot more educated now with things like YouTube, where they don't have professionals trading for them now. They just do it themselves through apps and through Vanguard, through low cost index funds. So before, 20 years ago, the stocks dropping, you may have the professionals advising, to cut your losses and sell, where now a lot of individuals are just holding on. And another theory I have why it's getting, so out of hand is, central banks around the world have been slashing interest rates. The Federal Reserve has done 3 interest rate cuts this year, and coincidentally, where I live in Australia, they've done 3 interest rate cuts, and in New Zealand they've done 3 interest rate cuts. And I'm sure, same with Europe, they've been slashing interest rates as well. I think in Switzerland, they're negative. Japan, they're negative. And in some parts of Europe, they're negative as well. So when they cut interest rates, it makes it more affordable to borrow, and people are willing to, if they can borrow at an interest rate of 3% and possibly make a return of 8%, people will borrow, because they can make more money potentially than the interest that they'll be paying. And then there's another theory which I have, which we're going to look at the U.S. Federal Reserve balance sheet. Now, If we go to 2014, when the US economy, was kind of at its peak, and since then they wanted to take some heat out of the economy, and they've started what we call quantitative tightening, where they've been reducing their balance sheet and they raise interest rates. Um, Now, then, what we saw in December, when when their interest rates were at their peak, um, the stocks started really dropping because people thought there were going to be more interest rates, um, more interest rate increases, and more quantitative tightening. And then the economy started to go bad. So, what most central banks do is they step in, they cut interest rates, and then they've even started expanding their balance sheets, which we see in September. The balance sheet has gone crazy, and then we also, if we look at the S&P 500, we can see. Let's go to September here. As they've been expanding their balance sheet, the S&P 500 has been, setting new all-time highs as well. So that tends to be what happens when the Federal Reserve banks cut interest rates and expand their balance sheets through QE or buying government bonds or equities. It inflates asset prices. Now, what they say they really want to do is they really want to, help create jobs, help the real economy like retail, where through consumer prices lift inflation. But what that really does is it makes it a lot harder for the middle class or the lower class, because most of the middle class and lower class don't own assets. Maybe middle class own a bit of assets, but not much compared to the top 10%. And it increases prices and increases the cost of living. So they don't get the benefit of higher asset prices unless they own their own home. But if they only own one home, they're not getting much benefit, because then if they sell out to get another home, the next home is more expensive. So it really only benefit if they own multiple homes. And as we've seen, throughout the past 10 years, if with all these asset prices and the cost of living rising and income stall, is it's really killed the middle class and the lower class, where cost of living throughout the world, through all the major economies, is rising rapidly. Incomes aren't rising rapidly. And if you think before, it just used to be a male with up to 5 kids and the wife staying at home. He would still be able to provide for the whole family. Where now we're seeing, a husband and a wife, or boyfriend and girlfriend, having no kids or just 1 or 2 kids, struggling on 2 incomes. So if they keep doing this, expanding their balance sheets and slashing interest rates to meet their so-called inflation targets, what's going to happen in the future? A couple's going to have to live together. 2 families going to have to live in one home. Are people going to have do 2 jobs, or do excessive amounts of overtime to keep up with the cost of living? So this is something very concerning, and something I've been thinking about a lot lately, and why I think it's so important to embrace a frugal lifestyle, embrace minimalism. Um, don't waste money on things that don't give you value, and really be conscious of what you're spending money on. If spending $10 a day on lunch every day, without really thinking about it, you might not realize you're spending up to $100 a week, just on loose change things. And if you invested that in 20, 30 years, you could have a significant nest egg, where all you need to do is invest, $170 or $200 a week, and you could be a millionaire, in 30 years. If the past performance is the same as future performance. So this is why I always encourage people to invest so they can benefit these, because that's what these Federal Reserves are really doing, is benefiting those that have assets, and the people that don't have assets are getting punished. Same with real estate. If they drop interest rates, makes it easier for people to borrow, and it inflates real estate prices and increases their cash flow because now they're paying less interest. If the rents stay the same, you're getting better cash flow. Um, so yeah, guys, this has been my thoughts. I hope you enjoyed this video, and I hope you join in on the conversation, and we can all help each other, get ahead, increase each other's financial IQ, and discuss these really hard-hitting, real topics that are happening in the world today. Okay, guys, I'll see you in the next video.